Hi, welcome to Arkintel. Everywhere you look, someone is talking about how capitalism is failing. But here's the twist. It's not. It's thriving. Just not for you. Not for most people. The economy is growing. Corporate profits are exploding. Productivity is higher than ever. And yet, wages for the average worker? Flat. Housing? Unaffordable. Healthcare? Bank breaking. The dream? Slipping further out of reach. Today, the top 1% of American households controls about 30 to 31% of total national wealth. The bottom 50%? Just 2.6%. Let that sink in. Half the population is fighting over scraps, while a tiny elite owns nearly a third of everything. But this isn't a fluke. It's not an accident. It's design. Capitalism isn't failing. It's rigged. Rigged to reward the already powerful, to concentrate wealth, to lock you out. And when you dig into the data, you realize something chilling. This isn't a glitch. It is the business model. Let's start with market power. Real capitalism depends on competition, right? But that's kind of vanishing. Like, for example, just 4 companies dominate over 80% of the US meat packing market. 2 tech giants control 99% of smartphone operating systems. And in the financial world, 3 asset managers, BlackRock, Vanguard, and State Street, collectively manage over $20 trillion. That's more than the entire GDP of the United States. And it's not just about size, it's about control. These firms own shares in almost every major corporation, and that gives them influence over pricing, policy, executive pay, even political donations. They sit on their boards, they shape lobbying agendas, and often they back both sides of a market or an election. You think you're shopping around? You're not. Most of your choices are illusion, whether it's banks, media, consumer goods, or even healthcare insurance. The list of real decision makers is shockingly small. Startup creation in the US, once a pillar of American innovation, has experienced a substantial long-term decline, with the rate of new firm formation falling significantly since the early 2000s. New businesses are choked by red tape, rising interest rates, and predatory pricing from monopolies. Big firms aren't just out competing, they are acquiring, absorbing, and burying anything that threatens their dominance. They don't fear disruption anymore, they buy it before it spreads. This isn't competition, it's consolidation, and it's the opposite of what capitalism was supposed to be. We've been told, work hard, play by the rules, and you'll get ahead. But for most people, the ladder has been pulled up. Today, where you are born, your neighborhood, your zip code predicts your economic future better than your grades, your grit, or your goals. Since 1978, CEO pay in the US has jumped more than 1,300%. Worker pay just 18% when adjusted for inflation. The average S&P 500 CEO now earns 285 times more than their median employee. In some companies, that ratio is over 1,000 to 1. And we are not talking about CEOs who invented vaccines or changed the world. We are talking about executives whose stock rose while they cut jobs. In 1965, the CEO worker pay ratio was around 20 to 1. In 1989, it hit 59 to 1. And now, it's so lopsided, it's almost dystopian. But these numbers didn't climb on their own. They were lifted by deregulation, tax reform, and corporate lobbying. And it's not just salaries, it's stock options, buybacks, tax loopholes. Executive compensation packages are ballooning, even as workers skip meals, delay medical care, and work multiple jobs just to scrape by. Meanwhile, housing prices have gone from difficult to delusional. Healthcare costs have more than tripled in 2 decades. College tuition has tripled since the 1980s, leaving Americans drowning in over $1.7 trillion in student debt. And yet, real wages haven't kept up, not even close. You are not underpaid because you are unskilled. You are underpaid because someone else is overpaid. And the rules are written to keep it that way. This isn't about laziness, it's about leverage, and most people have none. Fixing capitalism doesn't mean replacing it. It means rewiring the incentives, rebalancing the scales, bringing the game closer to what it claims to be, a system where effort and innovation are rewarded fairly. One answer? Stakeholder capitalism, a model where companies are held accountable not just to the shareholders but to workers, communities, and the planet. This doesn't mean abandoning profits, it means redefining what success looks like. Instead of asking, how much profit can we extract this quarter, the question becomes, are we building something sustainable? Are we lifting the people who keep us running? This isn't utopian. It exists. Take Mondragon, for example, a worker-owned cooperative in Spain. Over 80,000 employees, democratic elections, shared profits, capped executive pay. It's not just ethical, it's competitive. It's weathered economic crisis better than many corporate giants, precisely because it prioritizes stability and community over short-term gain. Then there's profit sharing. Studies show companies that share profits with workers see higher productivity, stronger loyalty, and lower turnover. When employees feel like partners, not just labor, performance soars, and the gains compound across time. And public options? They're not fantasy. Chattanooga, Tennessee has one of the fastest and cheapest broadband networks in the country, municipally owned and publicly run. It proves that when government steps in with fair services, private monopolies suddenly start working harder. Public options level the playing field. They don't eliminate competition, they restore it. This isn't socialism, it's smart capitalism, real competition, real choice, real accountability. For decades, the American middle class was the engine of growth. Teachers, factory workers, small business owners, they bought homes, raised families, paid taxes, and kept local economies alive. A strong middle wasn't just good for spending, it held the country together. But now, the engine is sputtering. In 1971, the middle class made up 61% of the US population. Today, just 51%, and it's shrinking fast. The jobs that built it, union manufacturing, teaching, retail, government work, are disappearing. In their place, gig work, part-time contracts, no benefits, no bargaining power. This isn't just about income, it's about access to security, to stability, to upward mobility. And when those vanish, so does trust in the system itself. A hollowed out middle class means more debt, more division, and a weaker economy, even for those at the top, because even billionaires need a society that works. Capitalism wasn't born perfect. It was built, shaped by laws, policies, and power, and that means it can be rebuilt into something fairer. Right now, the system rewards monopoly over merit, profits over people, and wealth over work. But it doesn't have to stay that way. We can choose a version of capitalism that spreads opportunity, not just extract value. One that builds a middle class instead of hollowing it out. This isn't about tearing it down, it's about fixing what's broken while there's still time to fix. Because if we don't change the rules, we are not players in the system. We are just collateral. And no one should have to spend their life surviving a game they were never allowed to win. If you found this video thought-provoking, make sure to check out why is everything still so expensive. In this video, we explore how greedflation is quietly raising your cost of living through corporate price hikes, shrinkflation tricks, and record-breaking profits, while fueling inequality and reshaping the global economy. click the video to watch now.